We are seeing Australian house prices grow the fastest they've grown in over 17 years. In this video, I'm going to discuss exactly what that means and why I still think we're early in this phase. Hey guys, my name is Ravi Sharma and I'm the founder and buyer's agent here at Search Property. Thank you so much for joining me on yet another episode of Search Property TV. If you're new here, smash that red button, subscribe. It's free, and of course, give me a thumbs up if this is the sort of content that you enjoy. Now, in this video, I want to talk to you about why I still think, and I know this is going to trigger a lot of people, but I believe Australian house prices are undervalued. Yeah, I know. We're seeing huge amounts of growth. Everyone is talking about how, prices are overvalued. Australian house prices are just out of control, but yet Ravi comes out and says it's undervalued. Now, of course, I know I'm going to cop hate just like I did 6 months ago when I said, look, COVID is not going to factor in negative prices for house prices. So negative growth, I didn't see it. I saw the complete opposite, and that's exactly how it played out. And now I'm saying that we're still early in what this next phase looks like. So that's why I believe it's still undervalued. We're in a unique position where it's both a seller's market and a buyer's market, which I don't think we've ever seen. And I'm going to discuss exactly why as we go through this. Australian property prices rose 2.1% in the month of February, recording the fastest month-on-month rise in nearly 2 decades, new data reveals. Fresh figures from CoreLogic released today showed that dwelling values across Australia rose in every capital city and regional area, showing a big upswing across the nation. Sydney and Hobart led the uptick, with both cities recording 2.5% house price growth in the month of February. To be honest, there's no surprise here. I was saying it for a while last year that we're going to see huge amounts of confidence come back into the marketplace, especially when we find out what's happening with the vaccine. And now it's been announced, and I think it's being rolled out in Australia. And so now we are seeing that translate into house prices. Is it the right thing for the economy? I don't think so. Is it possibly going to be detrimental to us in the next 5, 10, 15 years regarding affordability? I 100% think so. But the fact is, the government and house prices simply do not actually care about our feelings. Now, I see some people come out on YouTube and they say, oh, property prices are falling and they're going to, go down and they're crashing every year. And then there's others that are saying that, no, I actually don't buy property right now. It's, it's too much FOMO. The prices will calm down. Now, just look back as to what you were thinking 12 months ago. When 12 months ago, COVID was, in the system and everyone was like, oh, no, property prices will go down. The fundamentals here is what we need to focus on. It's not about you and I feeling like property prices are unaffordable and they should go down, and wage growth doesn't exist in our system, and the unemployment rate is so high. So why are property prices going up? Ravi, for me, it tells me that all the indicators are suggesting that prices should go down. Unfortunately, that's not how it works. We need to look at something that's called money supply. We need to look at real inflation, and we need to look at asset price inflation. The reason I say that it's both a buyer's and seller's market is because sellers are now getting huge amounts of attention on their property because, the demand is simply outweighing the supply. But I still think there's an opportunity there. Now, I'm not saying that because I'm a buyer's agent, and of course I know in the comments down below you're going to say, oh, look, he's a buyer's agent and that's why he wants us to purchase more property. I actually want the opposite to happen. If all of you guys don't purchase property, I can go out there and, have a very nice negotiation phase with a lot of agents and be able to scoop up some nice deals for my clients. But that's not the case. And for me, I've always been transparent that I would love to be historically correct than to just put out, junk that, will basically self-serve and help me. At the end of the day, I think the reason I'm here on YouTube and putting out free content is because I want to provide at scale. Now, of course, there's always going to be people that complain, and there's also those that can really take some value. Now, based on everything I get in terms of emails, comments, support, and DMs across Instagram, I'm super grateful that a lot of you are taking advantage of the information that's presented in these videos and actually going and executing. So I do know that there's some of you that are out there that really enjoy this content, and if you are one of those people, let's try and get this video to 200 likes. I know we can do it, guys. Index results as at February 28th, 2021. We've got Sydney up the top there with a monthly increase of 2.5%. It'll be interesting to know exactly where that's been occurring, because I don't think it's across the unit markets, as many people are believing. Melbourne 2.1%, Brisbane 1.5%, Adelaide is slowing down at 0.8%, Perth 1.5, Hobart 2.5, Darwin 0.7, and Canberra at 1.9. So what we really need to look here is, I guess, the trend, which is important. Now we can see with, say, something like Sydney, although we've seen 2.5, which is the highest, we've also seen the annual at 2.8, quarter was 3.6. So it's not really doing anything crazy right now. But then when you go across to seeing things like, Darwin, for instance, you got the annual at 13.8, then the quarter at 5.5, and now 0.7. That is definitely trending towards a certain thing. But I'm always more inclined to look at what's happening with combined regionals. And we can see combined capitals, 5.9% as a total return. Combined regionals, 14.4%. That is massive. And of course, if we look at national, the average is a total return of 7.6% across the country. Now, what does this all mean? It pretty much means, yes, all prices are going up across all states. Now, everything has cycles. The reason why we've broken out of what we believed was a cycle is we are entering an inflationary period. Now, we would have started this, I believe, last year, especially with a lot of this money getting printed into the system. Now, when money gets printed into the system, and I've spoken about this in depth across my other videos, so if you're new here, definitely go check out those other videos after this one. But essentially, it's our dollar losing its value because there's more money supply. And now if more money supply is available, that means we will see inflation. Now, what gets reported as our CPI inflation, it's a load of shit, right? And so the government shows it in a particular way because if they start showing that we're seeing, 6, 7, 8% of CPI inflation, well, then the country's gonna go mad and they're gonna go, well, you need to increase interest rates. However, if we increase interest rates, we have less economic activity because the cost of borrowing goes up. Now, when the cost of borrowing goes up, basically, it means that people have less to spend on other things. And that doesn't really get the economy turning. So in effect, they're just going to report fake numbers, right? And then that'll allow them to keep interest rates at all record lows. And then people go out and borrow money against their houses. They take out more equity, either buy more houses, or they go and renovate, or they buy simply a nice car. And this all generates more income, more action, and the velocity of money increases within the economy, which is of course good. So I actually believe these numbers are really small. I think we are going to see huge numbers come out by the end of the year. And a really good indicator for something like that is when banks are also coming out and saying, well, we think 10 to 15% in this year is, possible. When did that become normal? 10 to 15% is not normal, guys. This is not normal. And because they are saying it so frequently and everyone chucks out numbers and I chuck them out as well, guys, you got to understand, when I do my numbers, I look at 4 to 5% conservatively for capital growth. So when I come out and see these numbers and they say, well, 10 to 15% is how much it's going to grow. Can you imagine what thought process goes through my mind when I've been doing this for 7 years and I can see that this isn't normal. Everyone's trying to play it out as if it is, but we are seeing huge levels of inflation that are going to come into the system, and everyone that sort of sits there and goes, oh no, the market's going to cool down or crash, I think you guys are going to be in for a bit of a surprise. Spurred on by a combination of record low mortgage rates, improving economic conditions, government incentives, and low advertised supply levels, Australia's housing market is in the midst of a broad-based boom, CoreLogic report stated. The kind of synchronized growth hasn't been seen in over a decade, said CoreLogic Research Director Tim Lawless. The last time we saw sustained periods where every capital city and the rest of the state region was rising in value was mid-2009 through to 2010 as post-GFC stimulus fueled by demand. So anyone I've ever spoken to, whether it's strategy sessions, phone calls, or in person, I've gone to them, I ask you one question. If you could go back in time and purchase more property in 2008, 2009, and 2010, would you regret your decisions? Even despite at 2010, you're purchasing property that's probably 15, 20, 25% above what was the value in 2008. And no one has come back and said no. In fact, they say, well, in fact, not only would we have liked to have purchased one, we would have purchased multiple, knowing what happened after that. And this is where I'm trying to educate, right? It's more about education and getting information out there at scale. This is why I do it. And so what my thoughts are is exactly that. People that are purchasing now are going, well, yeah, we're purchasing, but it's like $10,000, $15,000 more than last year. I really feel bad about it. I get it. We were purchasing for clients. I was purchasing myself last year, and I can see what's already happened in the market. However, the market does not care about your feelings. they don't care about mine, certainly, and so they won't care about yours, is that despite property prices having gone up already, we're actually just seeing the starting of this, right? We haven't seen FOMO. We haven't seen huge amounts of euphoria into the market where everyone is involved, because right now the market is dictated, or at least driven, largely based on owner-occupiers, first home buyers, because they've got the incentives. We're going to have a lot of investors now trickle in to the actual system and start buying up as soon as lending restrictions start easing up. So what we are seeing now is very basic levels. And I know when I say basic levels, the numbers we're seeing are not basic by any means. However, what we are seeing is like nothing else. When I said 17 years ago, 2003, 2004, 2005, look at those numbers. Go and switch off this video after this, of course, and go and search what happened to property prices in Australia in 2003 to 2005. Then look at 2008 to 2010. Then figure out in context why I'm saying what I'm saying. Guys, we have not printed this much money in history. And this is not just us. Look at New Zealand, Canada, UK, US. Everyone is at record high prices, and there's a reason for it. So everyone that sits there and goes, oh yeah, property prices are gonna crash, property prices are gonna crash, they actually don't know what they're talking about, because this is simple economics. It's supply and demand, not just on the basics of, oh, well, there's not enough properties out there. The same excuse was being used last year. Oh, well, people on JobKeeper, JobSeeker, well, what happens when they get off? Nothing's gonna happen. Nothing is gonna change, guys. And then when they said, well, oh, well, you know, there's bank holidays. So when banks start going, you have to make your repayments and you can't, what's gonna happen? Nothing's gonna change, because there's so much money in the system. There's so much inflation coming in, and it's already happening. It's just people aren't really paying attention to what they're supposed to be paying attention to, is because nobody's really talking about it. If you come onto YouTube, how many people are actually talking about Australian house prices and them being undervalued in a time where we're seeing crazy numbers? I would say no one, barring me. And that's why I cop the most hate sometimes in the comments, but I'm okay with that. Because in hindsight, we look at what happened last year, 6 months ago, 9 months ago, even 3 months ago, when I was saying all this stuff. It does come true if you know what you're looking at. Now, of course, every year, if you say property prices are going to crash, at some point they're going to crash and they're going to correct themselves. However, if we see in this year another 10%, another 10%, and another 10%, collectively that's 30% growth. Now, if we see a 20% correction, well, the people coming out on YouTube or, you know, on Facebook saying, yeah, it was going to crash, I told you it was going to crash. Well, that's still at higher levels than what we're seeing today. That is why I'm saying that we are still very early in this phase, but it moves very quickly when we get into it. Regional areas still leading the upswing. House prices are continuing to rise faster in regional markets, 2.1%, than in capital cities at 2%, the report showed. Experts have described the popular drift to regional areas amid COVID-19 and remote work as one of the biggest trends of the 21st century. Regional areas generally recorded less of a decline in housing values through the worst of the COVID period last year, while also showing an earlier and stronger growth trend through the second half of last year, the report said. Obviously, I'm a bit of a regional fanboy, and that's not because I completely hate capital cities. In fact, I'm going to live in Sydney and I love it here, right? If I could buy 5 or 6 properties debt-free in Darlinghurst, I would. There's no complaints from my side. However, the majority of people have not got 5 properties in Darlinghurst. I don't, right? And so we've got to look at alternative ways in which we can build sustainable wealth through real estate. And I'm not just talking about, oh, let's just plug all our money in and then just eat tuna cans. No. I'm talking about how do we maintain lifestyle, yet still be able to grow this machine, the property portfolio, so that we can, you know, have good growth in our portfolio, but the cash flow allows us to continue living our life, because we're only 20 once, we're only 30 once, we're only 40 once. Do you know what I mean? So I don't think it's a better idea to put all your money into real estate and then sit there and go, oh, well, you know what? It's long-term planning, guys. In 15 years, I'll be rich. Well, you're just going to waste the next 15, right? And that's why I don't like investing in capital cities. And when people go, oh, well, units have better yields. Yeah, but units also have strata repayments, right? And so when you really look at what your net rental yield is, it's actually quite low. So 2 to 3% rental yields, even 4%, like that's tragic. And that's when I'm looking at regional areas. And now we're seeing the capital growth. I kept saying it, you know, just because they're regional doesn't mean they don't grow. They definitely grow, and we're seeing it. And the strong presence of what is happening there is actually just starting. I think we're about to see huge numbers come out from regionals as well, and that's why I think there's such a huge opportunity. But that does mean we're going to see rental suppression. If you guys want a video about that, definitely leave me a comment down below and just say, I want a video about rental suppression. That's as easy as it is. Over the December quarter of 2020, Sydney house prices jumped by 4.8%, underscoring the resilience in the city's property market, the report said. But the gap between house prices and unit prices have also widened, the Domain report acknowledged. Weaker investor activity has disproportionately impacted unit prices because they tend to be the preferred property type. There are also particular locations with increased supply as a result of heightened development in recent years. Guys, if you've been watching my channel, I hope that you've been educated enough to know that when these numbers come out, they're very broad-based. It's an average. So it's not that, oh, you've got a property in the middle of nowhere and you're like, oh, well, that's regional, so my property grew by that much too. Or if you're in Sydney and you actually have an apartment in a high-dense building in, say, Parramatta, and you're like, oh, well, that's the second CBD, so it definitely grew by that much. No, it didn't. And equally, if you're in the eastern suburbs and you have a really nice house facing the water, and that grew by, 15, 20%, you're looking at this and going, oh, what? It only grew by 2%? That doesn't apply like that. And that's why we look at these things, you look at these videos, it's just there to start prompting you to start looking further. This isn't, an end all means of research. This isn't the way that, you should go about your research. I think all it's doing is that it allows us to pinpoint, based on results, what is happening in the market, and it allows us to build some clarity around exactly what's happening. So if you are looking at investing, guys, don't just look at this and say, oh, well, Sydney's been growing, okay, I can buy anything in Sydney anyway. No, I think there's huge numbers that are coming out, but I don't think it's going to be as widespread across every asset type. You could end up buying the wrong asset and still do really badly in this market. So be very careful when you're out there. If you guys need help, there's strategy sessions on my website. There's also the online course, Confusion to Clarity. If you definitely want to get ahead this year, if you want to know one place, a one-stop shop where you can actually get all the information from figuring out your mindset, your strategy, and what are the different types of loans, then you definitely want to go and get the course. Enroll now. There's a link in the description below. But other than that, if you're new here, go check out my old videos. I'm not just some random guy, some property spruiker on YouTube that talks shit. I actually back it up with exactly what I'm doing and following through, but I'm also backing it up with real hardcore data. So if you're interested, definitely subscribe, and I'll see you guys in the next video. Thanks, guys.